Welcome back to Halftime Report. Now, Varroc Engineering isn't focused. Remember, the company divested or sold its four-wheeler lighting systems business in Europe and America. The stock initially on the announcement rallied about 20%, and then the next day post the investor call, the stock fell 16%. Srinivasan, the group CFO of Varroc Engineering, joins us now to talk more about that. Mr. Srinivasan, it's been a rollercoaster ride for the stock ever since the announcement came through. But I think the one concern that the street has is now that the global lighting business has been sold, what's left behind is the domestic business, which involves more of the domestic two-wheeler business, which has in any case been, in a big slowdown. How would you want to address those concerns?
Okay, I think there are 2-3 points I just want to clarify from a future outlook. So we have a very substantial and stable domestic auto comp business, which is, like you said, is mainly catering to the two-wheeler and three-wheeler segment. And in the current year, we expect that business to do revenue in excess of 5,000 crores, which is not a small amount by any means. So we are probably the largest player with the widest range of products. And on top of this, we are bringing to market broad, wide range of EV components for EV two-wheelers, starting with starter motors, DC converters, electronic control unit, and so on, and battery management system. All this together itself will amount to a substantial value per vehicle. And as the EV market, two-wheeler market in India picks up, this will also provide us an opportunity to ramp up the revenue growth significantly. So in that sense, we are well positioned to capitalize on this space going forward. In addition, we also have abroad, after the sale, two-wheeler lighting business, which is a global business, with operations in Italy, Romania, and Vietnam. And that business also provides long-term growth potential. In addition to the electronics manufacturing business we launched about 3 years back, where we are manufacturing a wide range of electronics for multiple applications based in Romania. So all this put together gives us, let's say, a lot of headroom for growth. And our strategy is to focus on these segments and deploy the resources to capitalize on this. So that is the main reason for...
Just one follow-up on the number. In your presentation, you said that post-divestment, the revenues will stand at a little under 3,000 crores. This is the pro forma impact of the divestment. And that is under 3,000 crores. That's for 2021, right?
That is for 2 quarters of 2021. We picked up Q2 and Q3, which is period not impacted by COVID, let's say.
Okay, so this 5,000 crore target that you're giving us is for which year?
That is for FY23, and that will be only for the India domestic. On top, we have the global two-wheeler lighting business, we have the electronic manufacturing, we have the IMS forging unit in Italy, and also our joint venture in China. So all put together, we are looking at, let's say, well over 6,000 crores or even more than that in the coming year.
And what about the operational
performance? In India that we are retaining, that we are not selling.
No. What about the operational performance? The 2 quarters that you've spoken about, margins are at 7%, the EBITDA margins. At 5,000 crore, what would the margin picture look like? And what does the debt at your books, on your books stand at? 2,640 is what it was pre-divestment. Is it completely going to be retired?
Yeah. If you look at, do a little bit of deep dive into margins, so you will see that the India business has been consistently generating EBITDA margins in the range of 10 to 11%, except for the quarters in which there was a major COVID impact on the revenues. So that base or the platform is still there. The margins currently are lower in the overseas business, which will be remaining with us, like the two-wheeler lighting and electronics, which are all impacted by COVID, and the revenue is not still up to potential. So with them ramping up revenues and improving margins, we expect to operate at double-digit EBITDA margins going forward for the group as a whole.
Okay.
Coming to the debt situation, yes, post-closing with the sale proceeds, on a net debt basis, we will be cash surplus. We will not have any debt. But how much of debt we retire and how we utilize the proceeds will be worked out in the coming months. Essentially, the focus will be to retire the high-cost debt and use the other funds to invest in the growth segments that I was talking about.
Okay, so just a quick clarification, the utilization of funds is still not decided as of now. A majority will go into retirement of debt. Will there be any kind of shareholder reward that you would be considering because of this sale?
Yes, yes, definitely. Because we are not paying dividend for the last 2 years, ever since the COVID struck. I think this, the investors have waited patiently for during the interim period, and I think it will be time to reward them as well. So once the closing is done and the cash is there, we will look at the dividend payout as well.
Special dividend? Will you consider a special dividend?
That call the board will take closer to the time. So it's too early to
Okay,
comment.
all right. You were telling my colleague about the operational performance. What about the profits? Because, you know, in your pro forma impact of divestment that you put out in your presentation, post the divestment, you'll still be loss-making. A loss of around 30 crores for the 2 quarters is what you've mentioned. By the end of FY23, is there any hope of turning profitable?
Yeah, that's what you're looking at is a bit of look in the rear view mirror. So I
Sure.
would rather look ahead to see what's coming. So last year we should keep in mind was impacted by the capacity utilization was significantly impacted due to let's say the lack of growth in the two-wheeler segment. The volumes have been sluggish, so which has had the impact on the margins, plus the impact of the commodity price increases, which there was a time lag in passing on to customers. So we expect those things to start improving this year and capacity utilization to grow up, and definitely we expect on a post divestment basis, on a net basis, the profit to be positive.
That's profit positive by the end of FY23?
Yeah, definitely. To the second half of this year, you should see the improvement.
Net of tax, what's the kind of cash that comes to your books post this deal?
We are looking at, like we indicated in the investor presentation, somewhere in the region of 160 to 175 million euros. So roughly, let's say close to 1,000 crores or thereabouts.
And you have 35 million in an escrow. What is that amount based on? What is the conditionality for it?
That is kind of standard in such deals. It works out to roughly, let's say, 5% of the enterprise value, or 6%, let's say. And that is standard in any deal. It's towards basically the representations and warranties we are giving to the buyer. And that will be released in a staggered manner over the next 2 years.
Okay, so we appreciate all the clarifications. It was much needed because of all the volatility that we saw in the stock, and the shareholders are a bit relieved, I guess. The stock is up almost 8% right now. Well, let's slip into a short break on that note. Jay Thakkar of Marwadi Shares and Finance will be joining in with some trading strategies on the other side. Stay tuned.
Real